if you're close to retirement or already there, one of the biggest decisions you'll need to make is how much of your nest egg should you still keep in the stock market. And the problem is that if you get it wrong, you could run out of money too soon, or if you miss out on critical growth in the market that helps keep you up with inflation, that could also hurt you in the long term. So in this segment, really, we're going to kind of helping you figure out what the right balance is between risk and security when it comes to determine how much you should have in the stock market. And with the recent stock market volatility that we've seen, it's going to be crucial to know your number. When we look at it, number one, there is the general rule of thumb. The general rule of thumb that I have heard in our industry is 100 minus your age. So again, if you're a 65-year-old retiree, if you take 100 minus 65, that would say that you should have about 35% of your money exposed to risk. I would say, that I tend to agree with as a general rule of thumb. My son is a perfect example. He's worked here for the past several years, finished college, and has a degree in finance. He's been involved in our 401k for a couple of years. And being that he just had his birthday, now he's 22, whether the market goes up or down within his 401k really doesn't matter. So 100 minus 22, he should have about 78% of his money in the stock market. And I would agree, grow, grow, grow. So that's number one general rule of thumb is 100 minus your age. Number two, you can take a look at developing what is called the bucket approach, the bucket strategy. In developing the bucket strategy, I also really like this approach as well. And what you want to do is you want to have a bucket of money that's designed to provide reliable income, especially if you're close to or in retirement time. So that reliable income says, how much does it take to cover your household living expenses? And you want that income to be covered from Social Security, pensions, or non-market risk investments. There's also a lot of advice that talks about having buckets of money. And, one of the buckets of money that they talk about is while you're working to have 6 months worth of income saved up. So my son who's working here, I would agree with that bucket of money is he needs to have 6 months worth of money because last thing dad wants him to do is call me up and say, hey, I need extra money because I can't pay my mortgage this month. I need money to cover my bills and expenses. In retirement time, what I want you to do is I want you to back that number up even more. If you're not going to look at having enough money and reliable income, I want you to have a bucket of money that would cover at least 5 years worth of your income needs in non-market risk investments. The reason I tell you this, because if and when the market goes down, having 5 years that allows you to shift your withdrawal strategy, taking money from stocks that are going down in value is going to give you time to allow those stocks to recover over time. And there's a much higher probability, I think, over a 5-year period of time that bucket of money would allow the stocks to grow back up. Your stocks really should be designed for some of the fun stuff that you have in life. So when the market does more than what's expected, those are the good years to do the improvement projects around the house, take the family on vacation, and spend a little extra money. And number three, what I think is when you're looking at how much money you should have in the stock market, it comes down to capacity for risk. So capacity for risk simply means how will a short-term loss impact your long-term goals? I'll give you an example. Tom and Debbie have a strong pension. They've built up a nice nest egg. They have money set aside in different savings account. In fact, right now they're just living off of Tom's pension, and they have been banking Debbie's pension for quite a few years since they retired. They're saving it up. And in saving it up, they have been putting the money in, even in their retirement accounts that they had before they retired, is pretty much all safe money. Now, safe money rates are better today than where they were a couple of years ago. So let's just assume that they're averaging a 4% rate of return. But a 4% rate of return in an account that's going to be taxable, whether it's a taxable account or a tax-deferred retirement account, you're still paying taxes on that. So you got to take, 25% of it away in the form of taxes. Now you're down to 3%. And then you minus inflation, and I think inflation is probably higher than what the government reports. At least that's my experience by going out, looking at things like the cost of food or the cost of living today. And you factor 4% minus taxes and inflation, all Tom and Debbie are really doing is losing money slowly, right? Not a good investment approach. They have the ability, and I was able to show them where they could take and reallocate some money into some quality stocks to be able to increase the amount of money that they had in the stock market by knowing what they own and understanding the got versus cost relationship and why some equities provided some good growth potential for them. Bob and Kathy, in their situation, they had a large amount of investments and they were built well. They had saved well. They probably even had more than they needed. Even if they had a healthcare crisis, they were essentially even, self-insured for long-term care. They also weren't the type of people that were ones that were making emotional decisions based upon the market did. So in their situation, because they're financially sound and saved a lot of money, have good income sources, it allows them to have the capacity to take more risk with their stock market investments, which gives them the opportunity to have higher growth for them in the future as well as to pass on in the form of the legacy. And that's exactly what they're looking to do in helping out their kids and grandkids with life in college. It's amazing to see because of their capacity for risk has put them in an opportunity to make a big, big impact on things and people that are important to them. Sequence of returns, on the other hand, can hurt people that may not have the capacity for risk. So those investors who have their money in the stock and bond market and they're taking a 4, 5, or 6% withdrawal rate, they may not have the capacity of risk. And in that case, what happens is if the stock market drops right away in retirement time, this sequence of returns could put them in an upside down situation. So again, when you look at it, there's three things to determine what is the correct allocation of your stock portfolio. The rule of 100, use the bucket approach, or what your capacity is for risk. And the market doesn't care about when you retire. Your plan certainly should. Knowing your number isn't just a financial calculation. It's really about a financial survival strategy before the next downturn or inflation really spikes and kind of you're second guessing what your decision is of how much to have in the stock market. I would encourage you to watch our video on the independent income system and take the first steps towards protecting your retirement while still growing for your future. Your window to get this right is right now.